Good morning, everybody. Thank you for joining this webinar of the Association of Corporate Treasurers on the topic of Brexit. It's the second webinar we've held on Brexit. The first was a year ago, shortly after the referendum. And I'm delighted to be joined by the two speakers who were on that panel a year ago, Stephen Powell, who is a partner at Slaughter & May, and Naresh Agarwal, who is a senior manager at PricewaterhouseCoopers and a member of the Treasury consulting team there. I'm Charlotte Morgan. I'm a member of the Council of the ACT, and I represent the ACT on a couple of committees in the city which are working on the implications of Brexit for financial services. And I'm also a non-executive director of Ford Credit. First of all, I'll just cover a couple of technical points. At the bottom of your screen, you should see a menu bar which allows you to open various windows. The yellow button with a question mark is for help if you have technical difficulties. And the purple Q&A widget opens a new window in which you can send us questions. We would really love to have your questions, as many as possible, please, and we will leave plenty of time to answer your questions after the panel have presented their initial thoughts. At the ACT, we encourage corporate treasurers to get involved in strategy as much as possible. So I would like to start by asking you a question, you the audience. We have a facility for a poll, and our initial question will be how much you personally are involved, or your Treasury Department is represented in the Brexit committee of your business, or whatever committee or forum you have for considering Brexit. While you're considering your responses, and please reply as soon as possible, but nevertheless I will meanwhile just give you a few of my own comments on Brexit as it seems to me as a corporate treasurer and also working in a business that spans manufacturing and banking. For me, it's been very helpful to be a member of the committee at AFME, the Association of Financial Markets, which has been conducting a survey of corporate treasurers and finance directors across the EU. We published our results on Monday of this week, and you can find the survey or the results of the survey on the AFME website. What we found was that treasurers, particularly in the EU 27 countries, were very concerned about Brexit, and particularly those in the smaller businesses who typically would only use one bank and therefore don't have such a range of bankers to turn to. And there were particular concerns around risk management services and cash pooling services. Obviously, in the UK, we've now triggered Article 50. There is a fixed end date when the UK would leave the EU unless any negotiations are concluded that extend that period. Meanwhile, we've had an election and a less clear majority following that, and we're seeing deep divisions in the two major political parties. So there is a great deal of uncertainty out there. But business has to cope with uncertainty. And indeed, the Financial Reporting Council is expecting listed companies to comment in their next accounts on the risks to their business of Brexit. So I feel this is something corporate treasurers need to be aware of, because it will be important that whatever messages appear in the accounts are consistent with the messages that you give to your bankers. At this point, I'd like to consider the results of our poll, and it's good to see that Treasury, the majority of Treasury teams are represented on the Brexit committee. It is 56 to 44, so a slightly bigger majority than the referendum last year. And we can ponder what this means for businesses over the forthcoming half an hour. At this point, I'd like to invite members of the panel to give their opening comments. And I'll first invite Stephen Powell from Slaughter and May.
Thanks very much, Elizabeth. I'd just like to address possibly three things for you all. First of all, what do I need to do to my documents right now? Secondly, what should I do in terms of keeping in with my banks? And then thirdly, what are my banks going to want of me? So just dealing with those in turn, looking at the documents, what do you need to do to your documents now? The answer, straightforwardly, is not a great deal. If you look at loan agreements, very few changes are recommended at the moment. The one thing to look out for really is the obvious point that if you've got a reference to the European Union in your document, think carefully about whether you mean the European Union, including the UK, or without the UK. If you look at your debt capital markets documents, what's going on there? Again, comparatively little. You will probably have a risk factor dealing with the risks of Brexit to your business. And you will need to think about the disclosure aspects of Brexit when you're disclosing the items about your business. So what effect is Brexit going to have on your business, so far as you can see at the moment? Look at other documents. ISDA, for example, again, nothing specific to recommend to deal with Brexit. There's a lot specific to deal with lots of other things at the moment. EMIR is of course one of them, but nothing really to think about from the Brexit point of view. And really the story is the same in other types of financial documents. So don't worry too much, I think, about your documents right now. The more interesting thing, I think, at the moment is for you to keep close to your banks. Just moving on to the second point. The advice remains that the banks are going to change the way that they deliver some of their products to you. Some of them may be setting up subsidiaries within the European Union and may wish to deliver some products, in particular to your EU subsidiaries, from those new companies. Now, question, is that subsidiary going to be backed by the parent? You need to assess, I think, whether you want to look at, have a separate credit limit for any new subsidiaries that you're going to have to deal with. You might want to think about collateral. So again, your thinking needs to revolve around the credit risk that a new entity is going to give to you. You might need new documents, hopefully in the same form as the last one. The thing I would recommend is please do try to hold the line and make it clear that having new documents with a new subsidiary is not an excuse that banks can then use to try to change the deal on you. Looking at the flip side then, what are banks going to want out of you? Well, they will want to know how Brexit is going to affect your business. So it's going to be really important for you to be plugged in to Brexit, to what is going on with your suppliers, with your customers. And so it's very important, therefore, for you to be up to speed on this. How will Brexit affect your business? How will, if we end up with loads of tariffs, because we are not part of a customs union with the European Union, how will that affect the cash flows of your business? Already you'll be looking at the currencies of your suppliers, of your customers. Now is the time also to look at their locations. Where are they supplying you products or services from? Where are you selling those products or services to? I think all of that is starting to really come into focus now and be something that you need to watch very carefully. And notwithstanding, I think we've had a year of not very much activity because of all the political aspects that Charlotte has mentioned. I think now developments will start speeding up, and I think now is the time really to start preparing.
Thank you, Stephen. Naresh, would you like to give us your views as well?
Yes, no, indeed. So I was just going back through my notes from last year, and Stephen, correct me if I've missed anything, but I remember there were three key themes that we talked a lot about. One was understanding what the current arrangements that you have in place are. Secondly, understand what's going externally, because constantly reminded that Brexit isn't just the only thing that's happening to economies and companies operating in the UK. We have elections going on. We have growth in various economies picking up than they were compared to last year. And thirdly, we talked about identifying and engaging with what's happening internally. And we've seen from the poll already this morning, we've had this afternoon, that organisations are putting in place Brexit committees and treasurers are needing and are doing engaging with those committees. But I'll pick those three things up in turn. So current arrangements and being prepared. I think, again, picking up some of what Stephen said, it's around making sure we've got all in one place, all, for example, of our intercompany loan agreements, so we know which companies and entities we're lending to, from what basis that arrangement is. From a tax perspective, we need to be mindful of what treaties we are using for various activities we're operating. Stephen's already talked about ISDAs and CSAs. And if nothing else, it's about making sure you can put your hand on all of these documentations, as and when it becomes clearer what these new rules will or may be. We talk about externally. I've talked already a bit about the fact that from this time last year, markets are now growing. We've seen the EU 27 finally showing some real signs of growth. Regulators are showing keen interest. So for those in the financial services sector, the Bank of England, the PRA have all written to them asking for detailed responses around how they're planning to respond to Brexit. We've also seen, we've talked about tax, we live in a global world, so we still have BEPS. So I think at my brownie point for mentioning BEPS again. But in the UK, we're still talking about trying to decrease the level of corporation tax. So whatever tax implications may arise from Brexit, there are other underlying themes going through, any good tax advisor. And thirdly, we've already talked about what's going on internally. As Stephen said already, we need to start making sure we're involved in conversations with suppliers and with our customers. We also need to think about what our competitors are doing as well, because no one should be sitting still in this environment and ignoring Brexit. Whether we are directly or indirectly affected, it will impact a large swathe of our European market.
Thank you, Naresh. And I'm pleased to say we now have lots of opportunities to hear your questions. I have an opening question in relation to the legal arrangements, whether to be a hard Brexit, in other words, if we left the EU at the end of the Article 50 term. I would like to ask Stephen, what would happen to UK law at that point?
That's still being formulated, is the straight answer. The policy of the government at the moment is to translate EU law as it stands at the point of exit into UK law. Now, you may think that's a very easy thing to do. Actually, it's far from it, because there are lots of really quite complicated things that need to be addressed. And so the so-called repeal bill is actually in reality going to be a continuance bill in many ways. Whether there's a hard or soft Brexit won't, I don't think, be affected too much by that. But clearly, the reality for people on the ground is going to be very different depending on whether we have a soft Brexit as part of a customs union or even part of the EEA versus a very hard Brexit where we have possibly tariff barriers between the UK and the EU and no ability to passport in or otherwise offer services within the EU over and above the World Trade Organization terms.
Thank you, Stephen, and I'm sure we'll return to that question of legal change and regulation in the discussion. We also have a question from the audience in relation to the planning that corporates might be considering should corporates make plans to move their euro cash pooling to another country? And I'd like to invite Naresh to comment on that.
Interesting question. Definitely today, no. I think it really depends on, first of all, what the banks are planning to do themselves. So we know that banks will have to respond to Brexit. They're setting up branches, subsidiaries. Barclays, for instance, is setting up a business out in Ireland, I believe. So a lot of it depends. It also depends on how important the pooling is to us as a corporate. I think that at the moment there's no reason why we would want to move euro cash pooling. It may or may not depend upon whether we continue to clear euros to the extent we are doing at the moment. I'm personally of a mind that says we will still continue to clear huge chunks of euro activity, even if we're outside of Brexit. So short answer to that question is, I don't believe we should be doing anything at the moment. My gut feel is we won't be needing to do anything in the future either.
Thank you. We also have a question on whether we see a likely increase in bank charges as a result of Brexit. Does anybody have any views? I mean, this is crystal ball really, but Stephen, would you like to make a guess on that topic?
That's very, very difficult to say, I think. And in many ways, I think charges are going to be driven by many other factors than Brexit. We know, for example, in the loan market, the pricing is dependent on relationships for straight corporate lending. Now, will that change after Brexit? No, I don't think it will. But will it change for other reasons? Well, quite possibly. And I think that tends to get repeated in a lot of areas. So short answer, I don't think Brexit will trigger these things, but I think it might be one of a collection of different things that may change pricing going forward. And banking will be more expensive. We all know that because of Basel and Basel III and CRD4. And that is going to have, I think, the biggest effect on pricing going forward.
So now I'm going to challenge you on that as well, provide a different point of view. I think also, I do agree that not because of Brexit, but because other things that are going on. So within the sort of payment landscape, so for example, PSD2, the rise of fintechs as well, the nirvana of blockchain, I think they're all drivers which will change how banks deliver services. And I think part of what we may see is a growth of more niche-related banks who are very good and very cost-effective delivering key services. So I definitely agree, general banking probably is going to go up in price, but the way in which it manifests itself to corporates, I think may change for other factors.
Yeah.
It sounds as though that there's some important challenges for corporate treasurers there to keep in touch with the new players in the market who may be bringing new services to our door, and we need to be ahead of the game in making sure we tell our colleagues about these services and identify the benefits to our businesses.
I'd agree.
Can we now move to a question which relates to trade finance? We've been asked what potential effect could there be on trade finance, specifically when providing bank guarantees to customers in Europe. Naresh, is this something that crossed your desk?
I must be honest, it's not something that comes up first port of call when I go talking to many of my Treasury colleagues. And again, if I think about what it is that drives trade finance and the use of trade finance, for me, it's really around growth of business and activity, expanding where we operate and where we sell our goods and wares. So I think it's going to grow. I think the fact that we may potentially be operating within a different set of tariffs and rules may require some additional comfort to our customer suppliers around what we do. So I think it may lead to increased use of, things we've probably not used for a while, bills of exchange, letters of credit, etc. We may see some new products coming up in response specifically to dealing with, an economy like the UK, which trades significantly with the rest of the European Union.
Indeed.
I think just to add to that, Naresh, I think you also may find, coming back to my point about keeping close to your banks, that your banks may well be providing some of these services from subsidiaries or operations within the European Union when they're providing it to your German subsidiary or your Italian subsidiary. And again, just watching that as to where these things are going to be provided from, I think is going to be very important.
There could be a whole raft of customs legislation that businesses need to become familiar with that we haven't had to worry about for many, many years, I would imagine. And there may be structures around discounting that might or might not make a difference depending on what the particular rules would be. And I guess, Stephen, does a lot of this depend whether we remain in the customs union or not?
I think that's the big question. So are we going to be in the customs union, in which case there are no tariff barriers between the UK and the rest of the EU? Or are we going to be out of the customs union, as certainly the government was suggesting before the election, and most of them seem to be suggesting today, but there seems to be a bit of doubt about that. And that really, as you say, it's something we've not had to focus on in relation to our imports and exports to and from the rest of the EU. And so if you are a business that is very much European oriented, then this will be wholly new to you, and you need to get a grip on that in your business. If, on the other hand, you're a business that has operated on a worldwide basis, so you export on an intercontinental basis, or import on an intercontinental basis, some of these things you will already have got to grips with because you're having to deal with it by reference to your imports from China or your exports to the United States or wherever it is that you're exporting to. And so in that case, I think what you need to do is just think about extending your analysis not just to if you like, intercontinental trade, but very much into your European trade as well.
Right.
But it's a big issue for all of us, I think. It's a huge issue for government to negotiate a load of new trade agreements over time. And I think it's going to be a real user of resource for businesses going forward, in particular, as I say, those businesses that have been European-oriented to date.
But also, I would think a potential opportunity for those that have the relevant experience. We've had a question, what do we see as the greatest opportunities for corporates? Would you like to elaborate on that?
Yes, I mean, I think there certainly are going to be opportunities, and we need to look out for them. And I think, it will be, a lot of it will be in perhaps other aspects of the business. Will there be cheaper places to get my supplies from because the tariff barriers will be lower from that country rather than a different country? That will be questions that people need to look at. Again, looking at our exports, will it be cheaper for us to export to company A rather than to company B? That will certainly come into it. And those people who have got a grip on all that, I think, will be in demand going forward. So, if you're certainly if you're a treasurer who's thinking of branching out into something else, then this might be an interesting thing to get involved in at the moment.
Yeah, thank you. Naresh, any comment?
No, and I think, it's a good question. And again, I've been sort of talking around through my treasury colleagues and also some of the banks as well. There's nothing they've seen today. But I think that's also partly because the last year has been really one of consolidation. And you don't suddenly get up this morning and decide you want to trade with, Guatemala. It takes time to plan, identify markets. So I do, whilst I was quite frustrated that I didn't feel UK markets had really grasped the export opportunities, I think it's really something in waiting, and something that is difficult to decide whether it's happened or not.
And the other thing is the time scale. It's not a 1 or 2 year time scale. Yeah. It's a 5 to 10 year time scale, I think. And so it is very much looking forward.
There's a question here around tax treaties.
Yeah.
I'm going to just pick on that. I was talking to Graham Robinson, who leads our tax advisory team, and one of the things he said to me, I'm definitely not a tax expert, so is there anyone out there who says I've got it wrong? I'm happy to be corrected. But part of what Graham shared with me is whilst we have some EU tax treaties, there are a number of bilateral tax treaties that are still in place. So even we stripped out some of these pan-European ones, there are some of these bilateral ones that still remain in place. And it comes back, I think, to one of the points I made earlier, which is as you pull a lot of your material together, you need to understand these are my agreements, these are my approaches that have tax impacts. And as we start to strip away some of the, say, European ones, we need to understand what are the ones we can rely upon. So it may be a treaty with the Dutch, it may be a treaty with the French or the Germans, but we need to be able to look through beyond the EU treaties we have at the moment to what remains that sort of residual tax environment. So it will probably have an impact on tax treaties, but it doesn't necessarily mean it's a bad one. It may go back to something that's still quite positive for the UK.
Well, that's good to know, yeah. Is there any indication that HMRC are setting out to help corporates with the transition?
None of my colleagues have spoken in glowing terms about proactive activity by HMRC.
Maybe that's something that we should be asking for.
I think it's one of many things that we need as an industry.
Yeah. Another question has arisen on the uncertainty that corporates face. The audience member has asked, should we be playing out different scenarios, e.g. fall back to WTO, and identifying the basic necessities that we need to have to keep trading? Stephen?
I think that might be something that is worth starting to run now. We are still, here we are 18 months away from the end of March 2019, and we still don't know what our trading environment is going to be. And so I think it might well be the case that you make an assumption. Let's assume that it's the worst possible environment that we might end up with. And I think, I'm being slightly unfair to the WTO here, but I think the WTO terms probably are the worst environment, in particular as they relate to trading goods. Trading services is a bit more difficult because the WTA doesn't do very much in terms of services. And maybe you then say, well, let's then make some assumptions as to what tariff barriers we might have to deal with. Now, the only indication we've got from the UK government is that the UK government is minded to erect tariff barriers that are the same as the European Union's tariff barriers. So you can go and look at those. It's really very complicated, I'm afraid. That you then need to drill down in relation to each individual product, and even within products there are then particular quotas from particular countries that need to be dealt with. So it's a very complicated area.
The quotas don't necessarily apply in the same way as they do now.
Yes, and so yes, I think it's the right thing to build a model, but beware, the act of building that model involves quite a lot of assumptions that you're going to have to make, and is going to involve quite a lot of work, I think, in order to come up with those assumptions.
And I'd agree, and I think we see, certainly financial service sectors, insurance companies are spending quite a lot of time thinking about financial impact on various scenarios. And I think, to be honest, whether the regulator requires it or not, I think it's really just good governance. We know something's going to happen, we're not quite sure what. If I was sitting on a board, I'd be wanting to know, well, let's look at a worst case scenario, whatever we determine that to be. WTA may or may not be a worst case scenario. What does that mean to my business? What does that mean to my balance sheet, my profitability? If we get a pretty benign environment, how do I take advantage of it? So I think that certainly a lot of the organisations have already started to move into a planning stage. They're not, unless you really are worried about passporting, they haven't yet put in place new organisational structures. They have started to play out through some of these scenarios. Well, what if we lose some of the tax treaties? What does that mean? When do I need to start actually just being aware and just fiddling with the edges? And when do I actually need to start thinking about moving part of my business, moving some of my people, maybe not doing some of the businesses that I used to write before?
And it does seem to me there that some of this you might think is not directly Treasury stuff,
right.
but I think treasurers have the skill set to really contribute a lot to this kind of process of just modelling what the worst case could be. And so I think this is a real opportunity for treasurers to go out and make an impact within their business to get that process moving.
That's good to hear. In relation to specific Treasury structures, one audience member has asked what are the considerations for companies with regional Treasury centres based in the UK? Naresh, have you been approached for advice on that topic?
Nothing specific, although one of my clients did talk about moving a Treasury centre into the UK. So we don't need to just think of this as businesses all looking to move or leave or reduce the size of what they do in the UK. I think that a lot of it is about just re-evaluating. And I would go back to a point that I think, Stephen, hopefully you'd agree with. It's not just about Brexit. This is when we look at a global environment, we look at things like BEPS and tax changes, we look at where we think growth is going to come from. Brexit is just one aspect. When I make my decision about do I want to run a centralised or decentralised treasury function, do I want a regional environment, really Brexit should just be one component of that broader decision making. I think the worst thing anyone can really do is take a knee-jerk approach to Brexit in a sort of silo-based decision making framework.
Yeah.
That's absolutely right. And the one thing I think, just to add to that, coming at it from the lawyer's point of view, is do not assume that the law to which we will be subject in the UK will be very different, or indeed different at all, perhaps, from the law that is going to apply in the rest of the European Union. That, to the extent that changes develop, they're going to develop over a period of time, probably quite a prolonged period of time. And so look at all the other aspects. It seems to me the law probably is not going to be top of your agenda in terms of making these plans.
Well, I don't think we could end a discussion on Brexit with treasurers without mentioning the dreaded E word of euro clearing. And indeed we have some questions about the potential loss of euro clearing. Any comments on that complex issue, particularly against the background of EMIR and MIFIR, which are already taking up a lot of our time?
Again, just talking to people both within PwC and outside of it, I think, first of all, it's very hard to regulate the foreign exchange markets. So no matter how much supervision they think doesn't exist in the UK, it requires further supervision. I think it comes down to market participants, how much they trust what's going on. And I think the UK has provided a very strong source of euro clearing. And then it's interesting what would happen if it didn't happen in the UK, where it would go to. And I'll just throw one comment someone made to me. He said to me he thought Chicago was just as viable alternative to Berlin or Frankfurt. And it made me realise that actually, again, when we talk about foreign exchange, global markets, these are truly global markets. This is not just a discussion about UK versus EU 27. You could argue, why wouldn't this happen in India? Why couldn't India be a clearer for Europe? So I don't know whether it's going to be lost. I don't know what the impact of losing it would be. I definitely don't think it's a foregone conclusion, no matter what we hear coming out of continental Europe.
Thank you.
I think that yes, there seems to be a sort of a thought amongst politicians that somehow they can have a major influence on this, and so there are levers that they can pull. But I agree with you. At the end of the day, it ought to be a market-driven thing, not a political thing.
I imagine that digital technology will play a large part of that, and access to different financial centres, cabling and so on will all be a very significant aspect of where that market goes.
Yeah.
Well, many thanks to the audience for those questions. Before we wrap up, I'd like to give the speakers a chance to give some closing remarks based on the discussion that we've heard.
Shall I go first? And then I think the key thing is for treasurers now to the extent you're not already part of the preparations for this Brexit, I think now is the time to be getting involved. I think the pace will change. I think it will accelerate. It has to accelerate because we've got a lot to get done in the next 18 months. But be flexible. The politicians will mess us all around, and we just need to be very nimble in the way that we deal with all that.
I'd like to share a couple of observations and then sort of a couple of things to think about. So a couple of observations, talking to some of the system vendors around whether treasury management systems have seen an increase in their uptake based on what we think Brexit may or may not impact. The general view seems to be has had no positive impact around companies wanting to put in new treasury management systems. If anything, what it's done is it's led to a delay in investments in any sort of new systems and infrastructure, which again for me was quite interesting. Talking to some of the dealers that I know very well at JP Morgan around how they see foreign exchange being used by the bank, by the corporates. I guess two or three themes came through from that. One is a lot of them haven't changed what they do. They have quite robust policies, and even with sterling where it is, they have generally not changed their broad policy, which I think is right because it's not just based on where the markets are, it's based on where your business actually operates. But I have seen a few that have started to use some tactical option strategies where we have big events, whether they were the vote last year, whether it's around the French elections or the German elections. So a few people looking at using options to mitigate one side or the other. And then I guess a couple of things to just leave people to think about. Throughout all of this, and hopefully Stephen would agree, a lot of this is about making sure you know what you have, making sure your house is in order. As my scout leader said, be prepared. We don't know what the future is going to hold, but make sure you know you have all the information at your hand so when we do see some of these changes, you're very clear what it can mean for your organisation. And again, although I'm not a tax advisor, I came across this phrase from Graham, understand your tax tensions across your value chain. So really, again, it's about understanding how your business operates. I'm going to leave one final pithy comment from Tim Curtis at Direct Wines. He said, be agile and keep your eyes open.
Well, that sounds very good advice, particularly in a time of great change in both business and political life. Before we wrap up, I'd like to give you the opportunity to give us our views on a second poll, which echoes the question we asked at the start, but this time the question is, should Treasury be represented in the Brexit committee of your business? And I'll give you a couple of minutes to answer that. And meanwhile, I would like to thank both speakers for their insights today, and I would also like to thank you, the audience, for your attending, and we've had a great turnout for this webinar. As you know, we run a series of webinars at the ACT, and we look forward to you joining us for future webinars and indeed for future events that the ACT is holding, which you will see on a slide. Also, just to mention, there's been a lot of talk about issues that the government is working on, and of course one of our major roles at the ACT is to represent our membership, and we have that opportunity in a number of forums to speak up and tell the government and other bodies what corporate treasurers want. So please do step forward on behalf of your companies and let us know the sort of topics that you think that government should be raising. The city is out there presenting proposals for a free trade agreement on services, and this is a great opportunity for all of us involved in financial management to say what we think that treaty should contain. So finally, I'd just like to check the results of our final poll, which is a resounding, yes, absolutely resounding, 98.1%. As always, not everybody agrees, and some people think not. So that's that's fine. And clearly, this is a topic which could be debated next time you get together with fellow members of the ACT at one of our networking events.
It's like a vote in North Korea for the next president.
Well, hopefully the sanctions are not so serious.
No, the 98%.
Agree
Yeah.
with the majority view. And so finally, I'd like to thank all of you for participating and thank the speakers again, and look forward to future discussions with you on this important topic and other topics in the financial arena.